BBC TV18, celebrating 15 years of leadership.
Welcome back to What the World Wants. We have been speaking with Jonathan Schiessl, the fund manager at Ashburton. Well, Jonathan, before we went into break, you were telling us that the recent growth numbers, the third quarter numbers, were a bit disappointing. It disappointed many on the street. Were you so disappointed that you are pushing back your earnings estimates?
Luckily, in aggregate, the companies that we own have beaten the sort of aggregate index level. We're very underweight in energy and the metal stocks. So I think if you exclude those two, key sectors, obviously it's not quite as bad as picture as it appears at a headline level. There's no doubt though that we do own ICICI Bank, and that was a disappointment. And that said, we own nothing in the public sector Indian banks, and certainly from the last time I was in India speaking to the banks, it was quite apparent that we had quite a few more quarters of the whole sour loan issue to sort of deal with yet. So that would appear to be still on track as such. So no, we're not aggressively altering any of our sort of earnings outcomes or where we expect earnings to go. We still think, broadly speaking, that the government is on track with delivering what it needs to deliver, and that generally the cost of capital is coming down for corporates. Obviously, we've had one interest rate cut. We're looking for that second one following the budget. That will certainly help from a corporate cost of capital perspective. And we do think that ultimately, with a more growth-orientated budget, people won't be quite so, we wouldn't be having this conversation that we're having now about sour earnings perhaps by the beginning of next year or the last quarter of this year.
Well, what kind of earnings growth are you factoring in this year and, more importantly, in FY16?
So I think if you look at this season, and the last couple of days I've not had a chance to keep a track of the numbers coming through, but I think it's certainly been disappointing if you include the big energy stocks and obviously those metals companies, as I mentioned. But we were certainly looking between 15 to 17% outside of those sectors. It is very much dependent on the individual stock as well. Some companies have been growing very, very strongly, even through the poor period of growth we've seen over the last couple of years. There obviously are some phenomenal opportunities out there for Indian corporates in certain sectors, and we're still very excited about the opportunities that are available.
What are your sector preferences now, and how will you allocate any incremental funds that you may get?
Yeah, so we still have a quite large overweight to financials. We are, as I said previously, we have nothing in the PSU space, in the financial space. So we have private sector banks, plus we have some non-bank financials as well. So we've been very comfortable with that view for some time. The other sectors we're very overweight would be industrials. We're about 10% overweight industrials, and we don't own L&T, but we have other industrials in the sector. And then the final sector where we've had a long-term overweight is the consumer discretionary sector. Now, I guess the question is, so we're still very comfortable to allocate incremental new funds into those areas. The one area where we are perhaps a little bit different from some of our other funds, some other India funds out there, is that we have absolutely a zero weighting to staple stocks currently. We find valuations in that sector particularly rich. And also, there's some individual company issues that turn us away from a number of those stocks.
Jonathan, you spoke about not liking public sector banks, but don't you find private sector banks as well expensive? Even the likes of ICICI reported a rise in bad loans. Isn't there a valuation argument in favor of public sector banks?
Yeah, that's a good question. We don't own HDFC Bank, which is obviously the darling of the sector, the more defensive play in the private sector banks. And obviously it's priced for, it is priced even more richly than the other private sector banks. We do own Axis Bank, we do own, as I said, ICICI Bank, and then we have a South Indian bank as well, Southern Indian focused bank as well. So, I agree some of the stocks have run up quite considerably, But we do also think that within a falling interest rate environment, with growth that we do still believe will be coming back over the next couple of years, that the banks, and particularly the private sector banks, remain probably one of the most safe vehicles to play that, if you like. The problem we have with public sector banks is obviously, first of all, their balance sheet issues, and obviously there was some news out, the government infusing capital into some of the PSU banks out there over the last few days. But the sector as a whole, I think our view very much is that we are minority investors, and it's who we align ourselves with is very important. So obviously having full faith in the PSUs and how these banks are run. Are they run in the interest of shareholders or in the interest of the major shareholder? That's a very important consideration for us, and that's one that when we start delving into PSU companies can become a bit murky. So it keeps us away from them.
Okay, at Ashburton, where do your analysts see crude headed this year? In fact, the entire commodity cycle, do you think it still remains in a downturn?
Okay, I mean, previously we've not tried to attach a single number. It's obviously there's so many different factors at play. It's very difficult to pin down a number with any degree of certainty. Our own internal sort of guideline is, if you like, is that we think prices will average somewhere between $55 to $60 a barrel this calendar year. We don't think that oil's going to scream back up to 80. We think that's quite, the chances of that are fairly small. What we do know is that we think that there'll be plenty more volatility. It's interesting when you look at oil counters and stocks in the US and Europe. Some of the services companies, they've been screaming back up after being very, very heavily sold off. However, I'm not sure if this is the time to be piling back into the energy sector just yet. We would expect the volatility to carry on for some time. I guess what you need to see is some fairly chunky supply taken out of the equation, and low oil prices will beget new demand, but obviously that's going to be a while before we see the evidence of that demand coming through. So we would think that we're still fairly comfortable with our sort of average price forecast of between $55 to $60 a barrel for this calendar year. And we were expecting the prices to probably push up towards the last quarter.
Ashburton is actually known as one of those few funds with an eye for Indian mid-cap stocks. Can you speak about your favorites in the mid-cap space? Are you looking to put more money in mid-caps, and if yes, into which ones?
It's been quite interesting. I think last year was, for most people running an India fund, if you had anything in the mid-cap space, you outperformed, obviously. So it's been, anything that's been mid-cap has screamed up pretty much over the last year or so. So it's a bit more difficult to find real value out there in a well-managed company with opportunities that the franchise can deliver on. We have been long-term holders of a number of mid-caps. We've owned them for quite a few years, and we're still very comfortable with them. I'd mention Tube Investments, which has a multiple of different businesses. We're still very, very comfortable with the underlying structure of that, and of course that's a big beneficiary of the government reforming foreign ownership of underlying insurance companies, because they have obviously exposure there. So we're still very, very comfortable with Tube Investments. Whirlpool of India, we've owned for a number of years as well, did incredibly well last year. Looking probably a little bit a bit more expensive in the very short term. But on a 3 to 5 year view, we still think that company has a great business opportunity, and also should start paying a dividend again, which should be very positively received by the markets. So there's a couple. I mean, if I'm honest, we're sitting on a little bit of cash at the moment, doing a lot of analysis on various mid-cap companies as well, looking to add a new position for the first time in some time. So we're quite enjoying, if you like, this little bit of a setback we're seeing currently in the markets. So we're running the ruler over a number of different mid-cap counters at the moment to add some more positions.
Jonathan Schiessl, it was a pleasure speaking with you and listening to you both on the macros and the micros of the Indian market. Thank you very much for joining us. That's it on this edition of What the World Wants from India.
CNBC TV 18, celebrating 15 years of leadership.